Starbucks, ticker SBUX, has seen some insane growth over the past year, rising from a price per share of $78 to a price per share of $100, which it is currently sitting at. Now, $20 might not seem as a huge increase, but in reality, that is almost a 40% increase since 2022. Now, if we have a look at the 1 month chart, we can see that over the past month, Starbucks has been falling in price by almost 8.2%. Now, this opens up an opportunity to possibly buy Starbucks at a discount price. Now, Starbucks is already one of the biggest brands in the world, and if we jump over to the monthly full, we can see that in 2021 they announced a partnership with Nestle to bring branded ready-to-drink beverages to the south and southeastern parts of the world. And if we scroll further down, we can see that this expansion is undoubtedly going to raise Starbucks' earning estimates, with analysts projecting a year-over-year increase of 18% through the year 2027. Now, there is no doubt that Starbucks is a great company to be invested in over the long term, but to figure out at which price you should buy this company at to maximize your investment potential, we will jump over to my fully automatic stock valuation spreadsheets, where we will have a look at the 9-pillar analysis and figure out the intrinsic value of Starbucks using the Grams formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model, where all these models will lead to our ultimate valuation at the end of the video. And as always, if you'd like to download these spreadsheets for your own personal use, you can do so at my Patreon at the link in the description. Now, if we jump back to the stock screener and plug in the ticker SBUX, all the metrics will show up automatically. And right away we can see that the starting dividend yield for Starbucks is sitting at 2.11%. Not a great dividend yield, but a decent dividend yield for a dividend growth company. This gives us a dividend payout of $2.12 and a trailing payout ratio of just under 60%. I generally like to see a payout ratio below 50%, but as Starbucks isn't in a highly innovative sector, a higher payout ratio is not as bad as it would be, for example, for Intel. Now, if we look further down, we can see that the institutional ownership of Starbucks is sitting in just below 75%, and the analysts predict a price of $112 by the end of 2023, which is about $12 higher than what the current trading price is. Now we can jump to the 9-pillar analysis, and right away we can see that the rating for Starbucks is 7 out of 9, with decreasing shares outstanding and a 5-year profit margin of 68.2%, which is a very good profit margin. We can also see that the price to free cash flow over the past 5 years and the 5-year PE ratio are both sitting above the values we generally like to see. But other than that, we can see that the long-term liabilities over the 5-year free cash flow negative dividends is sitting at 2.6. which means that Starbucks will be able to pay off most of their long-term liabilities in about 12 to 13 years using their historical free cash flow, while of course paying out a healthy dividend. Now we can also see that there is consecutive dividend growth, net income, revenue, and free cash flow growth, with the year-over-year free cash flow growth rate being slightly unrealistic. But if we scroll down to the financials, we can see that this is due to the transition between the years 2020 and 2021 through the coronavirus pandemic. Apart from this, we can see that the revenue has been increasing very nicely, as well as the net income, and there has been very decent dividend growth over the past 8 years or so. Now we can jump to the first valuation model, which is the Grams formula revised. Here we take the earnings per share of Starbucks and multiply by the average yield on AA corporation bonds. We then multiply the number we get by the sum of the base PE and the multiple of the 5-year growth estimate and the growth rate multiplier to get an intrinsic value of $84.40, which is 20% lower than the current trading price of Starbucks. Now this is mainly due to the very high current yield on AAA corporation bonds. If we plug in the long-term averaged on AAA corporation bonds, which is about 3.7, we can see that we get an intrinsic value of $104.24, which is 4% higher than the current trading price of Starbucks. But now let's move to our second valuation model, which is the discounted cash flow model. Here we plug in the free cash flow of the past 10 years, and the average growth rate is calculated automatically. Now, as we can see, the very high average growth rate is mainly due to the transition between 2020 and 2021, and therefore I project a forward growth rate of 6.5% with an initial growth number of 3,500 or $3.5 billion. And as we can see, that calculates the future free cash flow over the next 10 years. After that, using the discount rate, we calculate the present value of that future free cash flow. We sum it all up, we add any cash and cash equivalents, subtract total debt, and get an equity value of $93.7 billion, which we divide by the shares outstanding and get an intrinsic value of $81.79. But now we can move to our next valuation model, the multiples valuation model. Here I will be comparing Starbucks to MCD or McDonald's, Yum, and QSR, Restaurant Brands International, which I did a video on about 2 days ago, so be sure to check that out. We take these companies' current stock prices and divide by their current earnings per share to get their price to EPS ratios. I then average out those PE ratios and multiply by the earnings per share of Starbucks, and that gives me an intrinsic value of $85.12, about $14 lower than the current trading price, which means that Starbucks might be slightly overvalued compared to other companies which operate in the similar sectors. But now let's move to our final evaluation model, which is the dividend discount model. Here we take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 9.63%. Now I project the future growth rate of just under 9%, which is 8.7%. Now, as you can see, the intrinsic value of Starbucks comes out to be negative when we use the normal dividend discount model, and this is due to the projected growth rate being higher than the WACC of the company. And therefore, we will use our alternative dividend discount model, which is based on the stock price next year's predicted by analysts all over the world. And as you can see, this model gives us an intrinsic value of $107.29. But now let's move to our final valuation, where we average out the Grams formula revised, multiples valuation, discounted cash flow valuation, and the alternative dividend discount model to arrive at an ultimate intrinsic value of $94.61, about 5% lower than the current trading price. Now, if we plug in a margin of safety of 10%, that would give us an acceptable buy price at $85.15. Now I generally like to plug in a margin of safety of 15%, and if we plug that in, we get an acceptable buy price at $80.42. Now I currently do not own Starbucks in my personal portfolio, but I am planning on buying it in the nearest dip. I do believe that Starbucks is a great company worth investing into and that it will keep rising in price over the next few years. With that, if you enjoyed the video, make sure to leave a like and consider subscribing if you want to see more valuations like this.